Hello and welcome 12 Commerce students. Today in this class I am going to discuss with you the different types of solvency ratio. The different types of solvency ratio. So today the topic of discussion is solvency ratio. Now the first kind of solvency ratio is the first type of solvency ratio is debt equity ratio. Solvency ratio means it indicates, it measures the short term solvency of a firm. So first popular type of solvency ratio is debt equity ratio. Debt equity ratio, this I have told you earlier also, but today I will explain to you one by one what is the meaning of this ratio, what this ratio indicates, and how we will find out the debt equity ratio of a company or an organization. Now the name debt equity suggests that it is the ratio of the company's debt capital and equity capital. It is the ratio of the company's debt capital and equity capital. That is, it determines the company's capital structure. The company's capital structure is normally formed of two things. One is owner's capital, another is borrowed capital. Now the owner's capital is the equity part and the borrowed capital is the debt part. Now the company which is sound, the company whose financial health is good, does not depend upon equity share only. It depends upon the borrowed capital also. Company which can pay off the dues, company which has sound financial health, not only depends on equity capital but also depends on debt capital. But the company which is comparatively weak in the financial health does only depend upon equity capital and does not depend upon any borrowed capital from outside, because borrowed capital need regular interest payment and also borrowed capital need to be paid off first if the business gets dissolved. All the dues of the debt capital is to be paid regularly. So that's why company having good financial health depends on debt capital. But the company which is weak does not depend so much on the debt capital but depends on the own capital, which is the equity capital. So debt equity ratio indicates the ratio of the debt capital and the equity capital. Debt capital means the borrowed capital, the borrowed fund, and equity capital means the shareholders fund, the owner's fund. The owner's fund we can write. Now, how to find out these debt equity ratio? Debt equity ratio formula is long-term debt. Long-term debt by shareholders fund. Shareholders fund. Now, we have to learn, we have to know what items are to be included in long-term debt and what items are coming under shareholders fund. Long-term debt means those items like long-term debentures that are borrowed from outside, plus long-term loan, any type of long-term loan, that will come under long-term debt category. Whereas in the shareholders fund category, the items to be included is the owner's fund. Now owner's fund means the equity shares, the preference shares, the securities premium, the general reserve, the capital reserve, the surplus or the credit amount of the profit and loss, the surplus or the credit earned from PL account credit balance. So all these constitute the shareholders fund. All these constitute the proprietors fund. Shareholders fund can also be termed as proprietors fund. So these are the items to be included in proprietors fund. And debentures and loan consist of the long-term debt. So we have to find out the long-term debt first, then we have to find out the shareholders fund, and after that we have to divide these two to find out the ratio which is called the debt equity ratio of a company. It is expected that in case of a debt equity ratio, the equity portion will be more than the debt, because it is desirable that a company should depend more upon its own capital and less upon the borrowed capital. So equity part of the debt equity ratio should always be more to prove that the financial health of the company is sound. This is all about debt equity ratio. Now we move on to another important ratio of the solvency ratio part, that is total assets to debt ratio. Total assets to debt ratio. I write over here total assets. This is the second type of solvency ratio. Total assets to debt ratio. Total assets to total debt ratio, or total assets to debt ratio. Now, as the name suggests, in the numerator we have total assets and in the denominator we have debt. This total asset indicates the total asset the firm is having, that is fixed assets and current assets. Fixed assets and current assets. Whereas in the debt part we again have that long-term debt. We again have that long-term debt which we have done in the debt equity ratio. So fixed asset and current asset will come in the numerator and long-term debt will come in the denominator, and then we will find the ratio by dividing both of them. Under fixed asset what will come? All the machineries, equipment, furniture, building, etc. All the tangible fixed assets. And current assets means the stock, debtors, bills receivable, cash, prepaid expense, etc. will come in the numerator. And in the denominator will be same as previously we have done in the long-term debt part, that is debenture and long-term loan. So first we will add up all the fixed asset and current assets, then we will add the debenture and the long-term loan, and then we will divide both to find out the debt equity ratio. Here also it is expected that the total assets of a firm should be more than the long-term debt. The total assets of the firm should be more than the long-term debt of the firm, because assets must be disposable and it should be disposed of. It can be at the time of disposal of the business, assets can be disposed of to pay off the long-term debt of the firm. Assets can be used, it can be sold to pay off to clear the long-term debts of the firm. So it is expected that the firm must have more assets than its long-term liabilities. So this is the formula of total assets to debt ratio, and this is the second important solvency ratio. In the next class, I will also discuss the another important types of solvency ratio. These are the two important types of solvency ratio. Remaining two solvency ratio I will discuss in my next video. So wait till that. Goodbye.